Good evening to you. Good evening to all of you. Uh, Thanks for joining for the session on analyzing the budget. While this is on account budget, but let me begin by introducing the panel of invitees. So obviously S. Naren, who is one of the most brilliant brains which you have on the AMC side. So I'll just give you a brief background on Naren. He is from IIT Madras and he did his IM from Calcutta and he has been with the AMC of ICICI from last 19 years and managing one of the biggest AMCs for the country. We also have Pankaj Pandey. Pankaj heads the research for ISEC and he has also seen the markets for over 2 decades. We have been adjudged as best research house thanks to Pankaj for last 7 consecutive years. And my name is Manish Mehrotra. I'll be the moderator for the event. I take care of West Zone for Private Wealth Management of ICICI. Right. So once again, a very warm welcome to you. Now, this is on account budget. So a lot of people ask me, how does it work? What will be the emphasis and what will be the analysis of this? But if you were to go zoom back and look at 2019, that was also on account budget. While budget doesn't gives you a lot of inputs because there will be full-fledged budgets which we'll table later, but it has a lot of directional things and reading in between lines. So let me invite Naren to tell us in terms of two portions. One is in terms of how does this interim budget looks and is this any indication for the confidence which this government shows, and is it in line with the expectation of the market? Also, what is the market outlook going forward, given that we have Naren, so nobody would like to miss the opportunity to understand from him how the global players are looking at us, what is happening globally, how it will impact India, are we decoupled in a true fashion, is the domestic flow only going to sustain? We have shown a lot of resilience towards a lot of good parameters like CAD, uh, de- deplo- declining unemployment, and a lot of other parameters which are looking good. So, how do you see the portion, Naren? One is from the budget, which could be a non-event from a perspective that's what on an account, but is there anything to read in between? And secondly, how is the market outlook looking? Naren, over to you.
I think basically we were expecting also a vote on account budget, which is why we have not come on TV or not done any event anywhere because we knew that this would be a vote on account budget with no major changes in tax or anything like that. This government over the last 10 years has been very committed to macroeconomic stability and ensuring that everything is fine. So if you look at what this vote on account budget has also done is ensured that next year the fiscal deficit will come down and done no changes to anything. And, people always believe that in a pre-election budget, you will do some big giveaways. Even that did not happen. So it's a very, very good budget from a macroeconomic standpoint, which is very good for the long term. And and therefore very positive for the long term. And so, from that point of view, the reduction in fiscal deficit to 5.1%, a lower borrowing program against what was expected, resulted in a GSEC yield drop today, and interest rates on government borrowings came down today. So, from all those points of view, it actually was very positive from a market point of view because finally investors are investing in India because India is a good growth long-term story, and today's budget actually was supportive of that trend. So that is the positive. So coming to where the market is, the challenge at this point of time is not fundamentals. The challenge is, I would say, also not valuations on the large cap side. The challenge at this point of time is that there is too much positive sentiment due to which people are taking one-sided bets in India. And I worry about how investors in the derivative segment of the market actually are trading at this point of time, and whether they are aware of the risks of trading in this area. And that is the only worry actually. And I mean, I'm hoping that the investors who use ICICI Direct know exactly what risk they are taking, and they're actually aware of that risk, because it is not a fundamental problem. It is not even a valuation problem in the case of large cap, because frankly, I do not see a situation, as you know, even in 2021, market had touched 60,000. So, market has hardly given 20% return over the last 2.5 years. So it's not that the returns in large cap has been very, very high, but it is the fact that people take up leveraged positions and open interest in stock futures, the open interest in call options, open interest in bank nifty options, open interest in put options, open interest in nifty options. All of them are at reasonably record levels at this point of time, and that is what worries me from a investor angle, rather than the valuation of specific large cap stocks at this point of time. Do I worry about the fundamentals at this point of time on the economy? The answer is no, because India is a growth market and among the best growth markets at this point of time. I think the overall sentiment on the economy is also pretty positive. So I don't think there is anything really worrying. And, we used to worry about crude oil and all that about a year and a half back. That has also become range bound. And even when we have problems like in Red Sea and all these kind of things, we are seeing a situation where most of the commodities are range bound. And it is not as if there's so much money pouring into emerging markets at this point of time that you have to worry about flows on that side, because actually there has been so much redemption in emerging markets thanks to the fact that China did so badly that actually emerging markets and FII flows have been not so positive. That even in February, I would say that, in January, the entire emerging market trend has been negative. So it's not that FIs have been buying left and right like what used to happen in 2007 or something like that, that we have to worry about too much foreign inflow, therefore foreign outflow will happen. That's not the situation today. Foreign inflow itself is pretty muted, except in rare months like December 2023. Otherwise, foreign inflow has been muted most of the time. So I don't think that also is a worry at this point of time. So overall, I would say that due to too much positive sentiment, there is always scope for a good correction. Otherwise, I would say things are fine at this point of time. And we have a situation where everything is comfortable at this point of time. And so what we believe at this point of time from an investor point of view is that you have to invest cautiously or new money at this point of time, because of the way that you have elevated reasonably not cheap valuations and elevated sentiment. And all the old market, all the old investments, I believe you should run it, because I don't think markets are going back to where it is in 2021. So I would say you should stay invested with your old investments. And this is the kind of view we have at this point of time. And so broadly, earnings season has been average, not extraordinary. There are sectors like consumption which have not done well. Some of the sectors like IT, they outperformed very, very low assumptions. Sectors like banking actually have done well, but the stocks have hardly gone anywhere. And I would say that, so overall, I would say we are in the middle as far as those things are concerned. And many of the small cap and mid caps have done pretty well, primarily because those areas are where we are in a situation where things are, valuations are very high, because there's been continuous buying over many years in small cap and mid cap. So this is the kind of thing at this point of time. And I would say that there is huge long-term potential, but when valuations are high, just because you have long-term potential doesn't mean you make big money. And that is the reality at this point of time. So at the same time, so many people have been waiting for correction, and that correction never comes. So some of them have actually joined the bandwagon and bought it also. And that is what we've seen over a period of time. So on the whole, so it's a very tough time for a mutual fund CIO to give a clear view. I would love to give a view when markets are very cheap or when outlook is very bad. And we are in neither situation. We are not in a situation where markets are very cheap that we can give a big buy call and say invest aggressively. At the same time, we are not in a situation where markets are outlook is very bad for the country or outlook is very bad for the economy. We are not in that kind of situation. So we are in a very difficult middle situation at this point of time. And so we struggle at this this point of time on how to give a call. And that is the kind of situation we are in. So that's why we actually have been telling people, anyone asks where to invest, we tell people do asset allocation, invest in hybrid kind of categories, because that is what all our theories are saying at this point of time. So we have categories like equity savings, balanced advantage, multi-asset, equity and debt, which is aggressive hybrid category. These are the kind of things we like at this point of time. And that's what we've been telling people to do at this point of time. So broadly, this is where we are, and I don't have much to add at this point of time. So I will hand it over back to Manish, because we are in this middle, and that's where I'll hand it over to Manish. People ask me what are the pockets of euphoria. I say there are pockets of euphoria in PSU, there are some pockets of euphoria in small cap, some pockets of euphoria in mid cap. These are some of the pockets of euphoria at this point of time. Is the pockets of euphoria fundamentals? Certainly no. I think fundamentals are fine. This is broadly what I wanted to convey. Happy to hand over to Manish.
Thanks, Naren. People also would like to understand from you, like what happened with the Fed policy yesterday. Jerome Powell has said it will not do rate cuts immediately, but will not increase also. How it will impact India?
I think India has been reasonably unaffected. But if, for example, when Fed starts cutting in a big way, I'm told a lot of money will come into emerging market equity funds. So that will happen slightly later. That's what it looks like at this point of time. And but otherwise, I would say that it is a very comfortable situation from the point of view of Fed, because end of the day, we are no longer in an increasing cycle. We are no longer worried about inflation to the same extent. So I don't think there is any worry from the point of view of the Fed at this point of time. I don't think we fear Fed. What we don't understand is what's going on in Middle East. I wish I could answer that I have some understanding of what's going on there, but I don't understand what's going on there. Can that lead to some bigger problem? No one knows, but that's what I would say. But we are no longer worried about what's happening in the Fed. Can Fed act as a positive catalyst sometime in the future? Answer is yes. But when, we don't know.
Sorry, Naren, you are muted now. Can't hear you.
No, I could not hear you. Now I
Okay.
can.
Okay. Yeah. We had lost you in between. So the second question in terms of China plus one, where we were not swifter and we could not gain so much, but given that people are now looking at not only cost but risk also, do you think in next 4-5 years it's a good run for India and other emerging markets?
Yeah, but from the point of view of economy, yes. But from the point of view of markets, Chinese stock market is already discounting, everything is gone. So frankly, from the point of view of economy, maybe that what you're saying is true, that Indian economy should do much better. But look at the valuations of China. China is trading at absurdly low valuations at this point of time. So how much of the negative is already priced in Chinese stock market is very difficult for any of us to actually correctly judge at this point of time.
Thanks, Naren. So Naren, you were the early finders for the opportunity in terms of PSUs when PSUs were extremely cheap, and given that valuations have gone up. So what's your view on PSU infra and defense?
You see, where we are always strong at is, when markets are something cheap and valuations are cheap, our investment framework tells us buy aggressively. So, when we used to recommend PSUs, most of the people used to laugh at us and say, how can PSUs deliver return? Once valuations become high and it becomes common, we actually talk less about it. And we start talking about asset allocation, categories like equity savings, balanced advantage, multi-asset, equity and debt, etc. But today, PSUs is not value. PSUs is growth today. And there is even some pockets of euphoria in PSU at this point of time. They have been very well managed. That is a different thing. But they are no longer deep value or value at this point of time. They have been very well managed. Full credit to the government for that. But they are no longer value. They are growth. They're growth stocks. In fact, some of the growth sectors have become more value, and some of the value sectors have become growth.
Okay, what's your view on banking side, given that basically in the last rally of last year, the banking index has actually underperformed to the overall piece where market has grown by 20, small mid caps at 45% plus. Why do you think banking is not taken off, and do you think it's getting into a better value piece now?
Clearly, banking has become value right now. And all you need at this point of time is a period where there should not be big NPLs increase. That happens, banking has already become value at this point of time. And clearly, some of the private banks have become derated so much that the sector has become much more comfortable from a valuation standpoint at this point of time. This is how we see it. And so I would say that clearly, banking has become a value sector.
Okay, in terms of budget today, they announced in line with the market that 3.4% of GDP, around 11.2 lakh crores, will go in infra. What is your view on infra overall? Do you think infra companies have deep value, or these are growth companies?
Infra companies are not deep value, but they are not growth companies. They are priced for low growth, if you ask me. Except some of the areas in power and railways and defense, all the other areas are not priced for growth also, in my opinion. So I think this is the way things are. But I think defense and railways are priced for fair amount of growth at this point of time. And I would say that if the growth doesn't come at some point of time, they can have some clear corrections at this point of time.
In terms of defense, again, there were some things which are announced in the budget, and overall worldwide, if you were to see, defense budgets have been increasing. Like last year, India increased the defense budget by 11% post these two wars, where US and Russia were the biggest beneficiary. How do you think this sector, in terms of the listed space, do you think there's deep value, or these are growth stocks now?
These are all growth stocks now, virtually, and where the order book should keep coming and the order book should generate or profits at a good margin. They're no longer deep value stocks at this point of time. Far from it.
Okay. In terms of auto sector, people equate it to some luxury, some other ones. What's your view here in terms of auto sector overall? Also, there's some questions on the railway portion. How do you see railway from here? So two part of question. One is auto sector as a whole, and second is only on locomotive sector, railway sector.
Auto sector is an interesting sector, and we participated in the two-wheeler boom actually in the recent past. Now sectors like four-wheeler are turning out to be value areas at this point of time, given that the rest of the market has done very well, except four-wheeler at this point of time. But it's an area where we have to do good work. We have to find out which is the areas which have done well and then focus on them.
Okay, this question is on IT side. So what is happening in the US? If you were to see Nasdaq, that had a dream run last year, after on the back of a bad run. So do you think it is time where basically some of these companies doing well will also impact India? Indian IT sector will also look good?
The Nasdaq has much more of a high-tech component. Indian IT services is much more of a different type of component. We are believers in lower growth in Indian IT services companies, and so that is the way we look at it at this point of time. And we believe that the outlook is okay, but nothing exceptional at this point of time.
Okay. How do you read disruption in the market because of AI? Because there's a lot of news and talk saying that AI will disrupt the market. How do you see that impacting our markets? And which sectors, which kind of companies people should look at where the impact will be meaningful?
Basically, I'm not very clear how AI will operate, and but I think that in the long term, AI is going to have big impact, just like how a smartphone has had big impact on our lives. I think AI will have very big impact on our lives, but we will never judge it in advance. I think we'll learn it later. I mean, just imagine, none of us can imagine a world now without a smartphone in our hand. I think like that, AI will have such big impact on us, we will not be able to understand. But today, we don't understand what's going on in AI.
In terms of small cap and mid cap, you said there's a lot of frothiness in the market. So do you suggest that people should avoid it totally in terms of any small cap funds and they should only play by flexi cap funds or asset allocated funds, or do you think there's still merit in looking at some of them?
My view is that new money should certainly be looked at in multi-cap, in flexi-cap, large cap, then multi-cap. And they should not look at small cap and mid-cap at this point.
Naren, given that you have expertise on debt side as well, and you have been one of the fund managers who have managed debt for a maximum time in India, if you can throw some light in terms of post this tax regime, how will debt market grow in India?
We have to see, but my view at this point of time is people are not interested in debt. They find that the post-tax return on debt is so low that people are much more comfortable with equity or hybrid products because they don't find the returns attractive. In fact, one of the things we see at this point of time is a complete disinterest in debt at this point.
Okay. Naren, one view from you in terms of new age companies. So people saw a lot of frothiness coming in there, but now the valuations are again stretched and basically the funding has become challenge in between. So how do you see this sector, the new age, new unicorns of the country?
So actually, I keep telling my in most of my interactions, I have a lot of young people in my research team. They help me to take good decisions in that because they use many of these new age companies and actually give. And so it is along with them that I've taken the right decisions. You can neither say completely no, you can neither say completely yes. You have to take it very carefully because new age companies carries a high risk decision, and therefore you have to work with them. I have seen that that process works much better than trying to just say buy all the time or sell all the time.
There are two important portions which is impacting world globally is in terms of how the dollar will perform vis-a-vis the rupee and other currencies, and basically how is oil going to change the portion, especially for emerging markets like India, where we are big consumers of oil. So how do you read in this one? What's your view on these two?
Oil is now range bound. Somehow the US shale oil, as long as it keeps coming, has ensured that it is range bound. And that's why it doesn't move up, it doesn't move down. When it goes up, it comes down. When it goes down, it comes up. That's what we are seeing at this point of time.
And how about dollar?
Dollar, personally, I'm a believer that the current account deficit of US is so high that eventually dollar will come down. But what happens in the near term is very complicated because finally it's the reserve currency of the world.
In line of one of the observations, which is basically the uncertainty which comes before any elections, how should people play on that? Right now, a lot of people are confident that this government may come again. Having said that, if there's any turbulence, if there's any kind of surprises, how does one play in the market?
I think that's where I said, no, hybrid investing is the way to go. If you do asset allocation and hybrid investing like equity savings, balanced advantage, equity hybrid, and multi-asset, I think that's the way to go. And in my opinion, if you're trading derivative segment, you had actually have a clear process on how you're trading the derivative segment. I think these are the two ways you have to keep in mind that when you're doing this, you should know what risk you're taking.
Okay. In terms of view on certain commodities which are cyclicals, how do you see commodity market playing in India?
Commodities are okay, but it is controlled still by China, in my opinion, many of the commodities. So if China sneezes, the Indian commodities come down. But considering that China seems to have not continuously sneezed or gone to sleep, I think today is an opportunity for you to do some contrarian thinking on commodities at some point of time, because it is a sector which has done pretty badly. And unlike other sectors, this is a sector where you can actually take a bet and you're not buying it at the extreme top. You're buying it after a huge correction in the market.
Okay, then there's a lot of talk about a lot of deficit in terms of the total requirement of renewables. And basically, we still believe that obviously China is dominant player there. But how do you see this market? Is there opportunity for people to look at renewable energy?
Yeah, there is, but there aren't too many stocks, and some of those stocks have done extremely well in the recent past. So if you choose them, you're actually buying it after a very, very big rally. So that's why it's tough to do stock picking there.
Okay. Pankaj, you have any questions for Naren? Otherwise, we have few questions on the chat box.
No, I think Manish, it will be better if you take questions from investors.
Okay. There's one question which says, should we give low valuation to private sector bank valuations given the structural challenge of deposits, especially with increasing financializations and digitization?
Finally, we all need banks. I think there is no one who doesn't have a bank account. There's no one who doesn't use a bank account. Virtually all of us still use credit cards. So I believe due to all these reasons, I think the long term is still decent for the private banks. And over a period of time, they've gained market share. It is just, and the valuations have also got derated. So I think it is still wise to consider this sector for investing over the long term.
Okay, there's another question which says government seems to be allocating money to rural India indirectly, which is smart way. What are the new themes emerging out of this? If you can throw some light on that.
See, consumer staple sector hasn't done well, and consumer staple sector and telecom and two-wheeler are the three sectors geared to rural India. So out of this, telecom and two-wheelers are two sectors which have done recently well. So maybe it makes still sense to consider these two sectors. Consumer staple is the sector which has done very badly. So I would say that's a sector to clearly bet on from an investment perspective is maybe consumer staples. But the valuations have not corrected significantly. So you can't go thumping the table buy. You can consider it.
Okay, there's a very pointed question which says 300 units free through solar power for 1 crore house. How it will impact IEX? I don't know whether you can take this question directly on the stock side.
Tough to take it.
Okay, there's another one which is asking your view in terms of how do you see UK from here? Do you think there is, especially on FTSE side, if you're tracking FTSE, where do you see it's not gone up from the COVID time? So if you were to look at COVID highs and now, it has still not reached the same pace. So where do you see it going forward?
It depends on the composition of the index. I'm not an expert on that. So I think it's difficult for me to comment.
Okay, there's follow-on question which is on Japan. So what was so great? Why this economy, which was laid back economy and was not doing well, suddenly did 30% kind of return last year? What was the
We have been positive on Japan. Japan is one of the cheapest stock markets in the world, and it's a surplus nation and a very cheap market in the world, which trades at one of the lowest valuations compared to other markets in the world. So that's why we've always been positive on Japan.
Okay. Similarly, there's one more question on China, saying that when people moved money out from India, they took it to China thinking that India is 22 PE and China is 15 PE. Now China is available at 9 PE type. So does it make sense to look at China now?
Yes. But you have to remember, you have to have a contrarian mindset.
If you can elaborate on that, that would help.
See, 3 years back, we used to be very positive on PSUs. People used to say PSUs will never make money. But we were very confident because we could see low valuation and lot of irritation against PSUs. We were very confident because we had met those companies. We knew those companies had inherent strength. They delivered. Like that. Today, if you look at it, people are saying China, you'll never make money. So it's a very tough job actually to invest in China because valuations may be very cheap, but then people have to be confident.
Okay, in your mind, what could be roadblocks to our 7 trillion economy and 5 trillion economy plans, given that IMF also believes that we'll grow between 6.5 to 7%? So, what could be major roadblocks, if at all? What you can think of?
It can happen slower. That is the only thing. Eventually, it will happen, but it can happen much slower. Depends on what happens in agriculture, what happens in various things, how the global growth environment is. It will happen over a period of time.
Thanks, Naren. So that is it from your side. If you want to add anything further, based on this question, then we will move.
I think the point I want to add is that, see, one advantage or disadvantage I have is that I spent 35 years in the market. This is my 35th year. I always believe that the worst investment decisions or the toughest periods to invest are bull markets, like 2024. So one has to be very careful in this year, and one should be very careful, document why you're taking investment decisions, what kind of investment decisions you're taking, and then come to a conclusion on that, based on that. Because end of the day, what happens is that, if you take wrong investment decisions in a bull market, actually it can be costly. So I believe that you have to actually be careful in a big bull market, and you have to document. It's wise to document why you're taking good investment decisions before that you take the decision, and that will help you a lot. And the second learning that I have watching bull markets is practice asset allocation, which means that don't ignore the role of all the asset classes. Don't think of only equities as an asset class, which is the reason we popularize categories like equity saving, balanced advantage, multi-asset, and equity and debt. We recommend you to do that because asset allocation works in every big bull market. And, we think that India is a long-term structural story, but nevertheless, asset allocation works much better in a big bull market like what we're seeing at this point of time. And the third is, I believe that derivatives market is a very interesting market, but you should again document why you are doing any trade, understand the risks of every trade before doing any trade. These are my mantras for 2024 and beyond. Thank you very much.
Thanks, Naren. So now, thanks, Naren. So now we'll move to Pankaj Pandey. Thank you, head so Pankaj, how do you see this budget? There were some interesting announcements which were made, but there were a lot of in between lines which people have to read. So if you can throw some light on how do you read this budget?
Just a sec. So Manish, I've got some slides which I will share, and then I'll move to how we sort of view the market with budget in perspective. Is that fine?
Yeah, please go ahead.
Now, coming to budget, I think the highlight of the budget has been that the capex-led template has been sort of maintained to deliver economic growth. So I think that has been the hallmark of this government for quite some time, and this budget was no different. So overall, the allocation for capex grew by 11.2 odd percent. So overall, as a percentage of GDP, it is still higher at 3.4% or lifetime high at 3.4% for FY25. So that was one of the key takeaways, and I think government. So we didn't see much of a populist measure, except for the fact that government is looking at direct benefit transfer for a lot of these social benefit schemes, be it for say for example for women or even for farmer or a lot of other stakeholders. So from that perspective, budget did not carry any kind of a populist measure, and which is why we like the budget. I think the other fact was that on the fiscal deficit front, it was expected that the government will meet the fiscal deficit target for this year. So they did meet that. From 5.9, they achieved 5.8. I think what was a positive surprise was that the market was expecting about 5.2, 5.3 as a fiscal deficit for FY25. The numbers came in at 5.1. So definitely that was a positive surprise because what happened was that the market was looking at a borrowing of about 15 lakh crores plus. I think that is going to be 14 lakh crore. So from that perspective, that was a positive surprise, and there's no wonder we have seen impact on some of the PSU banks, and I'll come to that later. Now, when I look at the overall proposals for 2025, I think most of the numbers look quite sort of okay. So we don't really see this government sort of overcommitting in terms of growth. So I think, like last year, overall our sense is that this government is going to sort of talk less and deliver more. And that is what we are seeing even in the budget proposal. So some of the key takeaways is that see the nominal GDP growth rate for next year has been taken at 10.5%. Last 2 years we have been growing in excess of 7%. Overall, RBI is still expecting GDP to be about 7 odd percent even for next year. So with 4.5% kind of even normal inflation, your nominal GDP growth rate ideally could be 11.5%, but the government has taken 10.5%. Even the tax revenues have been very seen very nominal increase of 11.5% in line with the overall growth, and even the same is the case with even the indirect taxes. On the disinvestment front, also, while the government is missing their disinvestment target of 51,000 because they are going to achieve over 30,000 odd crores. Next year, they are again not over promising in terms of disinvestment target being kept at 50,000 crores. And mind you, a lot of PSUs which were up for divestment, I think should happen the likes of, say, for example, IDFI Bank or other PSUs. So if that happens, I think these numbers look quite achievable. And obviously, the highlight has been the overall CAPEX allocation. Now, in terms of some of the popular schemes like, say, for example, Narega scheme, so there the allocation has been largely constant, or even the kind of payout what the government gives to farmers. So I think the government gives about 6,000 rupees per annum to about 11.6 crore farmers. So allocation for that also has been kept as same. So no major challenges there. Subsidies also have been largely okay, given the fact that crude oil is not going to sort of go in either direction, and which is why, as highlighted by Naren also, so our sense is that some of the key key subsidy items like say fertilizer, I think has been sort of kept at about 1.6 lakh crores, so which is quite normal. Now, on the CapEx side, obviously, as a percentage to GDP, we'll be spending 3.4 lakh crores, which is one of the highest. But overall, when we sort of look at the key segment, continue to remain road and railways. So that is where the bulk or 50% of the CapEx is going through. And I think one also needs to see it from the perspective that prior to 3 years, the government has been sort of been even more aggressive in terms of CapEx allocation. But since what we are seeing is that CAPEX has multiplier effects, we are also seeing the overall benefit of even the private sector CAPEX sort of picking up. So, which is why government has really not sort of maintained the same tempo, but is sort of moderated from an absolute amount perspective. So I think that was the expectation, and I think that is the need of the hour also, because I think this year we are expecting that Indian bonds will get included in some of the global bond indices. So which is why the government finances need to be in shape, and which is what the government is looking at. So which is why they are looking at the overall fiscal deficit going down below 5% in FY26. So nothing much to complain from the budget. Overall, most of the numbers have been pretty good, and so from that perspective, it's a overall good constructive budget, and nothing much to complain. So now coming to overall sense of the markets. Now, Manish, our sense is that what implication what we sort of look at is that see, if you look at today, we have seen movement in a lot of PSU banks, especially coming from the perspective that if the government is going to borrow lesser compared to what was anticipated by the market, so as a result of that, we have seen yields declining by 15 bips. And we all know that Fed is about to cut rates probably in the second half of this year, and even RBI will also follow rate cuts going forward. So our sense is that probably this year we might see 75 to 100 bips kind of a rate cut. And rate cut is a sort of a positive for banks, especially PSU banks. Now, to give you some color, if we see a 50 bips kind of a decline in yields, a big bank like SBI, could witness a profit improvement or impact on their profit is about 9%. and which is even for something similar for even Indian Bank, or even for some of the other PSU banks like say Bob or Canara, you could see impact of about 5 to 6 odd % for each one of them. And which is why we have seen that with yields declining, some of the banks did exceptionally well today. And our sense is that with the kind of setup overall for this year, in terms of Indian bonds getting included and government keeping the finances or fiscal deficit in shape, overall our sense is that the cost of funds will decline, the yields should soften, and that should have a positive rub-off on banks. 100 bips kind of a decline could easily lead to 15 to 20% kind of a jump in profit for some of the PSU banks. I think a fraction of that is what we have witnessed today for some of the banks. So PSU banks are clear beneficiaries of today's budget, and structurally also we believe that this is one pocket ideally that should sort of do well from going forward. Now, coming to overall sense of the market, now since I highlighted that what we are seeing at this point in time is that the budget was not populist. So the expectation that we might see some kind of a profit taking ahead of elections, I think that has been put to rest. So our sense now is that we will see probably a post pre-election rally, and so historically, whenever we have seen before elections, typically Feb and March is the month when some kind of a correction happens. And we've already seen that correction of 4-5% in the recent past. And from there on till elections, we see a low double-digit kind of a rally in the markets, and which is why I feel that largely with the overall setup and with the election or with the budget not being populist, our sense is that we would see a sort of a pre-election rally, and probably Nifty could cross 23,000 levels by the mid of this year. So that is a view which we are carrying on the market, especially with the budget in context. But for the entire year, our sense is that Nifty earnings are in pretty good shape. So overall, Nifty earnings are going to grow at 16%. Valuation wise, things are okay. So at 20 time multiples, our Nifty target for this year is 25,000. And since the government has been focusing, or the template what the government has been following is more of a CAPEX, so the entire value chain looks good to us. So right from so some of the themes which we are liking for this year and even for the next few coming years, one obviously is the CAPEX cycle. So again, it will be a combination of core sectors like cement and steel, and also the green growth which is going to come in sectors like power, or the kind of manufacturing push which the government is undertaking through PLI. And then there are some pockets which should sort of benefit from the structural, what I call, or structural beneficiaries, the likes of banks or real estate, for that example, for that matter. So that is one which we are sort of liking, because both the sectors have seen structural measures. So banks typically post IBC, we are seeing a clear change in borrower behavior. Real estate is one sector where the organized share is quite less, at below 20%, and so the organized players have a lot more headroom to sort of keep growing, even if the industry is sort of stagnant. And I think bank is another sector which continues to do well, or which should continue to do well. So bank is another, and then obviously auto is another leg where the premiumization trend is getting quite stronger. I mean, when we sort of look at the kind of top end demand for most of the products, most of the models, auto is clearly looking like a good sector to be into. So from that perspective, we are very constructive on the market. But when I sort of put a lens from the budget perspective, our sense is that overall PSU banks relatively look a lot more attractive. So that's all I have to sort of share, Manish, and I'll be happy to take questions if there are any.
I have Pankaj, too many questions for you in the chat box.
Yeah.
So one is basically sharp divergence between small cap and mid cap stocks, especially in IT. How do you see this playing out?
So one is, I think, in IT, definitely yes. You look at the tier two IT names; they're looking a lot more better, or their overall growth is a lot more constructive, and obviously they are commanding even better multiples also. So tier two are definitely looking better, and market is usually sort of giving a lot more weightage to companies which are going to deliver far more better growth, despite the fact that even if they are a bit costlier. That is what we have seen. But even within tier one, so what we like is something like, say, for example, Tech Mahindra, and our sense is that by next quarter, the new CEO will come up with a growth plan. So valuation-wise, that is one stock which is looking attractive, but ideally should do well if the overall growth plan comes back in shape. Otherwise, structurally, I am not very bullish on IT from the perspective that it's very difficult to take a call on global markets, especially US markets, or the kind of spending what can come by. Because commentary from most of the companies is still soft, so they are still not seeing a major pickup happening in next 1 or 2 quarters. So which is where the domestic oriented sectors are looking a lot more better. But within IT, like I said, within large caps, probably something like Tech Mahindra or the tier two names like Coforge or Persistent, I think those are looking better.
Okay, Pankaj, this is a direct question. Your opinion on HAL versus BEL. They're saying if you can't talk on a specific stock on this one, then on these sectors you can give us a comparison. Where do you think you should allocate bigger money?
Now, within defense, what we are liking, Manish, is more of, say, for example, Midhani. So, Midhani is a company which is into specialized alloy, which is eventually going to be used if we localize a lot more aero engines in India. So, that will be the company which will benefit. But between HAL and Bharat Electronics, I think our preference would be with Bharat Electronics. I think this is one company which has been sort of doing pretty consistent growth, and uh, while HL is definitely the talk of the town, but already the stock has done very well. But structurally, what we are liking, why we are liking Bharat Electronics more is that you look at all defense equipment, the share of electronic component is sort of going up. Say from 35-37%, it is expected to go beyond 40%. So this company will keep on doing better with higher content addition. So between the two, Bharat Electronics is what I would prefer.
Okay, Pankaj, the next question is psychological. They're saying basically, are we looking at something like 2014 where there could be lull for next 2 years, or are we looking at 2003 to 2007 kind of euphoric rally where we are at the beginning and we are wondering whether we should put more money, but it could be a very handsome return kind of scenario.
So, Manish, I am of the view that this is more like 2003 to 2008 kind of a rally where the large caps did about 6x, the mid cap and small caps did about 9x. And this we have been sort of quite vocal. And the reason why we believe that this is more like 2003 to 2008 is largely because two of the big sectors. One, obviously, is the CAPEX cycle is fairly in good shape. Up till now, the government has been anchoring the capex, and now, if you look at even from the commentary of Siemens or even from the commentary of L&T, the private sector capex is also looking up. So capex cycle is up and looking up. The other is the real estate as a sector. So that point of time, the real estate as a sector also did well. And mind you, real estate is a very important component of our economy. I mean, why China is sort of facing a challenge is that 30% of their GDP directly indirectly is driven by real estate. This real estate as a sector is coming up after a decade of underperformance, and our sense is that this is a multi-year cycle. So real estate is here to stay for some period of time, and it will have multiplier benefit for number of sectors because a lot of the ancillary sectors, be it paints, be it switches, be it building material products, cement, steel, all of it sort of benefit from this sector. So that is one, and obviously it has implications even for consumption because it is one of the largest employers of unskilled labor, not in metros but in tier two, tier three towns. So our sense is that both these sectors are looking good, and which is why I feel that this is more like 2003 to 2008, and not like 2014.
Thanks, Pankaj. The other question is in terms of pharma. So do you think the pharma rally which had come in post-COVID and some other rallies which had come in, they are there to stay, or do you think we should? How do we play this sector?
So pharma was the first sector which did exceptionally well because there was a perception that when the COVID happened, that the demand for medicines will go up not only domestically but globally, and it did also. But what it did also was that it created a high base effect for most of the pharma companies, and a high base and then price erosion in key markets like US. I think that sort of led to these good amount of volatility in the numbers for most of the pharma companies. I think next 1 or 2 quarters down the line, most of these issues are sort of behind us. So you'll see more of a structural growth rate which will sort of pan out, and which is what we are clearly seeing in terms of some of the key players like say Sun Pharma, Dr. Reddy. These specialized portfolio or the complex generic portfolio for them has been already sort of doing well. The margin profile there is better, and the domestic portfolio is also sort of doing okay with the 10 to 12% kind of a growth. So pharma from a growth bump up and then to a sort of a low period of growth amplified by price erosion, I think is going to witness a more of a normal growth. So as a sector, we are liking that sector from the perspective that growth is will get normalized, and which is why the stocks will do well. So the kind of volatility what we've seen post COVID, I think is going to subside.
Sure. So what about railway stocks? Some of them have already moved up. Do you think there is still steam left, or these are like basically avoidable now?
So I will not really jump into railway stocks at this point in time because there are some stocks which we are also sort of scratching our head in terms of how to sort of justify some of the valuations. So which is why I would not sort of suggest to sort of look at these stocks. You get a lot of proxy stocks for growth. So bank is obviously one of the proxies for growth on the infrastructure side. So I think banks are a better bet to sort of look at rather than some of the railway stocks. So I am slightly, or I would get comfortable if we see some bit of a price correction and time consolidation.
Sure. Pankaj, next question in terms of bank NPAs. So if you can compare bank NPAs of private sector bank and PSU separately, how do you think it measures versus private banking and PSU?
No, so largely, if you look at most of the NPAs, so we had a system level NPA in excess of 11%. Now that has come down to closer to 3 odd percent. So obviously, bulk of this NPA was attributable or was residing in PSU banks, and which is why most of the PSU banks have taken a bigger knock than compared to private sector counterparts. But now things are sort of looking up, especially for PSU banks, because when you sort of look at a key bank like, say, for example, PNB. PNB, while they have sort of provided for most of their bad assets, but they are also sort of witnessing aggressive recoveries also sort of happening. So PSU banks are definitely relatively looking a lot more better, but also some of the private sector banks are also sort of looking good. So banking in general is looking good. Relatively, I am liking PSUs more.
Okay, Pankaj, next question is in terms of solar power, where government has announced certain things that we will give some relief. How do you see this sector, and where do people benefit from here, especially in listed stocks?
So I think, what government is principally looking to do is that we want energy security, and for that energy security to happen, hydrogen is considered of the fuel of the future. Producing hydrogen largely is going to happen through renewable means, and so which is why this entire space is looking attractive for the next 5 6 years. It will require massive amount of capex. Now, a lot of these power names have sort of done well, but I will sort of stick with some of the tier one names, like, say, for example, NTPC. I think this is one company which has got 70,000 plus megawatt kind of a thermal capacity. Plus, they have got the balance sheet to sort of put up a capacity of 60,000 megawatts of renewable energy. So I think both they've got the capacity and also the overall directionally also things are looking supportive for them. So I think I will stick with the tier one companies and tier two companies. If we get some bit of a correction, then I think the tier two names. But this is one space one should not ignore for the next 5 6 years, because if you are able to crack hydrogen, which is what most of your tier one corporates are looking to do, then I think we are sort of, it's a bigger picture is that we are aiming for energy security, and you never know, we might become exporters of hydrogen going forward in future if we are able to manage the cost dynamics very well.
Okay, Pankaj, this is an interesting question, which says which sectors one should totally avoid for this investment year. Do you think large caps will deliver higher returns than mid cap, small caps? So basically, two part of the question. One is which sectors are totally avoidable.
So I think, Manish, so one is I think I'm not really liking the consumer staples as a space because so this is one segment which is already sort of done very well when the margins have been very or margins are at a decadal high, and also valuation wise they are not really cheap. So most of the stocks are trading in the range of 50 to 60 times 2 year forward, and growth wise they would at best deliver 4 5% kind of a volume growth and probably something similar pricing growth. So if my Nifty earnings are going to grow at 14 15 odd percent, so they are likely to underperform Nifty growth, and multiples can't expand. So so structurally, I would want to believe that some of these pockets will sort of underperform. Now, even within some of these segments, like say BFSI, my sense is that a lot of historical outperformers, be it the like of HDFC Bank or probably Kotak Bank or Bajaj Finance, see these stocks did well when we had very limited universe which was sort of delivering growth, because most of the other pockets or most of the other stocks were sort of struggling for growth. So they got the over allocation to these stocks was on a slightly higher side. Now, if you look at, you are seeing a lot more sector or stocks offering similar growth patterns, and which is why I think the incremental allocation to these stocks will not sort of come, and which is why I would want to believe that some of these historical outperformers, whichever sector they belong to, they might sort of underperform.
Okay, Pankaj, your view with this budget on defense stocks as well as auto stocks.
So defense, I already said I would like some of the names like, say, for example, Bharat Electronics or some of the other defense PSUs like Midhani Mishra Dhatu Nigam Limited, because they have relatively not done so well in terms of price performance, and also the tailwind for them or overall for them in terms of growth, I think is quite back-ended, because for a company like Midhani to supply titanium alloys or specialized alloy, I think they are going to take time, because the localization of engines is going to take some time. But I think these are the names what I would prefer. On the auto sector, I think Maruti is looking good at the current levels, because while we are not very enthused about the growth prospects, because they are going to launch only one EV model this year, and they're talking of sub 5% growth, but it's available at 20 multiples. So it's a big stock with a historical, what do you call, good track record, available at a decent multiple of 20 times. I also like some of the battery manufacturers like Exide and Amar Raja. I think the content per value for them is going to go up, because battery cost is a significant cost for a EV vehicle, and both these companies are putting a significant amount of capex there. So I think those are the stocks which we are liking in auto ancillary space.
Okay, Pankaj, these questions are pointed in terms of stocks from steel and cement sector, which you like.
So in cement, I think Shree Cement looks good, because I think this is one stock which is now available at quite attractive valuation of about 16 times EV by EBITDA. Otherwise, I think most of the cement stocks are looking good, be it JK Lakshmi Cement, be it JK Cement. On the steel side, I'm still sort of skeptical. So for example, till the time China experiences volatility, I'm not too sure how steel stocks will do well, because last 2 months also we've seen steel prices correcting by 11, 12 odd percent, and the Chinese dumping continues. Till the time we don't see China sort of exports getting contracted or declining, and or the government putting some measures in terms of say anti-dumping measures, till that time probably steel stocks may not sort of do well. Otherwise, once that happens, the risk reward, like Naren highlighted, is quite attractive in steel stock. The only issue is that timing is very difficult to give. But we like all the tier one names like say, Tata Steel, JSW, Hindalco. So all of them looking quite attractive.
Sure. Your view on companies like Nestle Liver, given that rural demand is low, but still the values have not. There's time correction of 2-3 years in these ones. So how do you see them?
So, like I said, most of them are trading at 50 times forward, 2 year forward. Growth is not, or overall revenue growth or bottom line growth is unlikely to beat Nifty. So my sense is that these are stocks one can hold if you want your wealth to be protected, because they'll do more of a time correction, not price correction. But if you want your wealth to grow, probably these sectors or these segments will not help you outperform.
Okay, the other question, again, pointed question, HDFC, post merger and post the current pressure on name, do you think it's a buy, or we should exit and look at some other opportunities?
So HDFC Bank, previously we were carrying a target price of 2050. We have reduced it to 1800. So it is still a buy, but see, the challenge with HDFC is that from 4.1, 4.2 kind of a margin, they have come down to 3.4. And they are still going to take a decent amount of time to sort of recoup the margins. And like I said, HDFC Bank did exceptionally well, or Kotak did exceptionally well when a lot of counterparts, especially in the private or PSUs, were not doing so well. So obviously they got oversized allocation. The multiples for them were quite higher. Now you are seeing almost all PSUs or some of the private sector counterparts doing well. So from that perspective, I am not very positive on HDFC Bank outperforming. It will do well, but if you're thinking to sort of outperform, then I would suspect that they are going to outperform.
Thanks, Pankaj. That's the kind of questions we had. If you want to add something towards the last closing comments.
So overall, what I would want to highlight is that every year we could see corrections, say ranging say 10 to 12 odd percent in large caps, about 15% in mid caps, and probably higher in small caps. But what our sense is that next 5 to 7 years are looking structurally very positive for the markets. The kind of, not saying that we are going to get the same magnitude of returns, the kind which we see in between say 2003 to 2008 kind of a period. But most of the things are looking like it is more of a rerun of that scenario. So, which is why one should not get disturbed or perturbed by the kind of a correction, which is a normal correction of 10 to 20 odd percent across large caps, mid caps, and small caps. So structurally, you should not leave the market, but at the same time, if the markets have rallied, one can sort of wait it out. Or if we see get a correction, then that will be a time to sort of put lump sum, depending on whichever sector one is comfortable or pockets one is comfortable. I think all the segment, be it large cap, mid cap, and small caps, they are expected to sort of do well. But obviously, each one of them will carry a different amount of risk. So I think it is a lot dependent on what kind of risk appetite an individual carries.
Thanks, Pankaj. So thanks, everybody. So a couple of things which I would like to summarize. One is obviously Pankaj said that we could be looking at a rally which we had seen in 2003 to 2007, which is euphoric, but it was continuous rally. Also, McKinsey had said that this is not India's decade, this may be India's century. So I'm saying exciting times. The only thing is you have to look at your risk appetite and look at asset allocation accordingly. So thanks for joining. Very good evening to all of you, and enjoy the day. Thank you.
Thank you, Manish.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.